Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach the art of trading at Trading University. First market we'll take a look at will be the Australian US dollar. Aussie US dollar, you can see it came down pretty good. Still, however, holding that longer term pattern, like I say, intermediate term pattern. I think we're going to go to our RTT ratio. That's really going to define things a lot better for us. And there's the picture in the Aussie. Look at the vast majority of your patterns are down. You got a lot of momentum down. Basically, you have one pattern up here. You can never rule out that pattern holding it. It's an important pattern. 2 points I want to make. One, you have the momentum down pretty good, so I'm not sure how that support will hold up. But number two, I'm still holding out that you could have a historic bottom in place down here. In my experience, though, you generally have a steeper retracement and a retest of that bottom. It may not get to it again. Let me get to the daily chart here. You may not see probe below 69 even, but you'll probably have a test to 70 even. And at that point, I'll reevaluate. I don't have any skin in the game here. I don't have a position on here, so I'm just going to have to keep an eye on it. But longer term, from an investor standpoint, I think 70 is going to be a pretty interesting level to watch going forward. Probably need to get the strong U.S. retail season that we're right in the middle of now out of the way before we'll take a look at that. So I think there's some time there, but Aussie worth looking at down below there. Next market, dollar Swiss. You guys know where I sit on this. This is I'm long dollar Swiss myself. Essentially, that's my biggest position. And what's amazing to me is I've been buying dips in this guy all year. Last time I looked, I was up over 10% on that trade. That really surprised me. I would have thought I would have been break even or so. What's interesting about that is basically if you've been buying dips all year on this, you're in the chips now. You're in the green, so you got dry powder. So from my perspective, I'm like, oh wow, they're not even hurting me on that. I would have thought it wouldn't have surprised me if I was even below water a little bit. So what am I going to do next time it dips? I'm going to buy it again, right? And then when it does break out above par here, I'll add to that position then too. When it breaks out above par, the bulls are really going to be in control right there. So hey, as a bull, I've been surviving all year in essentially a down market. So if they couldn't hurt me there, in fact, I'm already up a little bit on that trade, then I'm looking pretty strong on this guy, and as always, I'll pan out to that monthly chart, and I'll show you why I call this the trade of the decade, really the investment of the decade. I think you have so much room up above there for a variety of reasons. I mean, everything's going to end up working against Switzerland, from the Iran-U.S. treaty to the European economy to essentially the war on terrorism. It's really highlighted the importance of cybersecurity, and that's going to work against those old-fashioned Swiss secretive banking laws. Anyway, long story short, I think you have to be accumulating dollar Swiss down here. I think there's plenty of room on the upside when it breaks above 100. Look out. I don't think it turns back from there. Likewise, if you get a dip in here, that's going to be one doozy of a dip to buy. Same story in the next market. The dollar index itself. You can see that downtrend highlighted over the last 6 months or so. Really, that defines the new seasonal in the U.S. economy. You tend to get a really slow retail season after Christmas into the spring, and you had it again this year, and you can see it equates to a bear market, a mini bear in the dollar. Well, we think that 6 month bear is going to morph into a 6 month bull, and we think you're going to go a lot higher here. Again, the next dip to buy, we think, is going to be a doozy. So you definitely want to keep an eye on that. As we said a couple of weeks ago, the data is going to start favoring the dollar. The data is going to favor the U.S. economy. And when you get into an area where the pattern is shifted higher, here, let me show you where we stand on our ratio, because this is how we determine how we trade short term for sure. And there's the dollar index. You can see the 6, 12, 30-day pattern, they're all up. So as a day trader, no doubt about it, you're buying dips. You take your 12, 30, 60, and you can see the majority of those patterns are up, right? The 12, 30 up, 60 days still down. So as a shorter term swing trader, you're a buyer, right? Because we always trade with the majority of patterns. So day trader buying dips, short term swing trader buying dips, right? So that's a lot of firepower, given that the majority of traders out there tend to be shorter term. Longer term swing traders still eyeing selling rallies. So yeah, they'd be looking to work the short side. So you still have reason to sell rallies in here, and you can't definitely rule out dips in that market. I just think the next dip is going to be a doozy. That's going to be the time to jump in there and use leverage. Also, I'm long the dollar UUP in my IRA account. That's easily my biggest position in my IRA. So love the dollar. Pretty much the status quo for me when it comes to the dollar. Being a dollar bull, and you're in that area of on the calendar now where you'd expect a reversal. So buying a dip becomes very important to me. Next market we'll take a look at is the gold market. Gold broke down here. You had pretty good support there. It was going to go after that 13 even level again. Last week was the time to do it, and you broke down support. Swing traders will still be eyeing the long side. Here's my gold ratio, and you can see only your shortest term patterns are down. As a day trader, you'd be selling rallies in the gold. However, as a swing trader, when you highlight the 12, 30, and 60, you're definitely still buying dips. As a short-term trader, long-term swing trader, you're definitely buying dips in the gold still. So we'll have to see what happens. But again, I come back to that theme that you're going to see stronger U.S. numbers now, economic data. You saw it in the retail sales number in May. That's going to be a trend that's going to continue. You have a pretty powerful seasonal down for the euro. That's probably going to work against gold. Definitely going to work in favor of the dollar. So, for me, it comes up dollars. And again, remember, if you're a dollar bear, you better have made your money in the last 5-6 months, because that was your window of opportunity. If you haven't made it then, look out going forward for dollar bears. And again, I come back to that Swiss franc position. Last time I looked, I was pretty amazed. It was up, so they couldn't hurt me the last 6 months. Now I'm in a stronger position. So if I am, so are the other bulls. So bulls definitely going into a stronger position here. Last market we'll take a look at will be U.S. interest rates. Here's the 10-year U.S. note market. Remember, higher prices equate to lower interest rates, whereas lower prices equate to higher interest rates. Once again, the 10-year Treasury held that important 2/3 level here, big level. So as prices slide lower, that means higher interest rates. The Fed's on record saying they'll probably raise interest rates in June. Wouldn't surprise me at all if they did, particularly if you continue to see good U.S. economic data. So higher rates point to a normalization of the economy. Normalization of the U.S. economy points to a stronger dollar. My name is Jay Norris. I teach the art of trading at Trading University. Thank you so much, and we'll see you next week.